Hi, I'm Terry Sawchuk, founder and chairman of Sawchuk Wealth, and today is it's Wednesday, May 18th, kind of a gnarly day in the stock market. So I want to talk about that. We're going to do a relatively short podcast this week. Just a lot going on, and I think investors are a little bit concerned, and naturally, I think they're a little bit confused as to what's going on because I think we've got some conflicting signals here. All eyes are on the Fed. So we're going to talk about that. And we're just going to go over a list of things that I think need to be considered right now. So we'll start with the leading indicators. It's clear by the sales of petrochemicals. So petrochemicals are just things that go into things that we make. And the things that we make are the things that we buy. And it could be anything from cars to electronics to you name it. Okay. And it's been pretty clear since the beginning of last year, really, that the petrochemical sales were starting to fall, and they've fallen off a cliff now. And so that's a concern because I think it clearly shows that demand is starting to roll over. There's a lot of talk about inflation, and certainly we have high levels of inflation right now. But there's a bifurcation in the inflation story because on one hand, you've got demand-driven inflation, and I would say based on what we've seen so far, the demand side of things has been steady but not overwhelming, and it's starting to fall. So I think that, that's one thing to keep an eye on. I think car sales are going to start to go down. Housing starts have definitely fallen off, and we'll get to some of the other statistics in the chart here, but the leading indicators are definitely suggesting that there's a slowdown imminent, which would help sort of resolve the demand side of the inflation equation, at least to some degree. Certain types of demand, like there's inelastic demand for shipping, trucking in particular, and because diesel gas is a refined product, it's in short supply, and as a result, diesel prices are going to go up. That's going to contribute to inflation. But as demand overall starts to slow down, that also affect probably the diesel fuel consumption to some degree. And again, I think that helps the inflation story there. Now, what hurts the inflation story are a number of things. One, we certainly have supply chain disruptions. Now, this started with what happened in COVID, but when you look at that started to get a little bit better. Then, of course, we had the unfortunate situation where Russia invaded Ukraine, and so that creates a whole host of issues. Number one, Russia is a huge exporter of energy, both natural gas and oil. And so the fact that they're being sanctioned and other countries don't want to buy from them, even if they're not being sanctioned, that's going to take a certain level of supply off the market, which means the remaining supply goes up in price. So you've got that issue. Outside of the energy, certain metals that go into producing EV batteries and EV metals that just go into car production coming out of Russia, that's not helpful because that supply is being constricted. Wheat, obviously a food export. I've seen some pretty dire warnings about a potential global famine. I take that with a grain of salt. While I do think that there are going to be some shortages, I also think there are probably some fundamental ways to solve those issues. And so I'm not buying entirely that we're going to have this massive global famine. But I do think that food's going to get more expensive, and B, in some parts of the world might be harder to come by. And certainly in some very poor areas of the world, they could have food-related issues that might cause excess deaths. And that sucks, especially with the amount of money that exists in this world and the technology that we have. You would think we'd be able to solve that problem by now. So I'm hoping that this is a little bit more, kind of scare tactics and headline grabbing as opposed to, an actual reality. But time will tell. There's no question that the cost of fertilizer has gone up. So obviously, if you grow things like food, it's going to get more expensive. And even think about this, the cost of golf will go up because, it takes a lot of fertilizer to keep a golf course green and to keep it in shape. And so, whether it's food or entertainment, things like that, it's all going to get a little bit more expensive. And so that's going to get passed on to the consumer. And I think so as we start to see this crossing of higher costs butting up against what we'll call the upper end of what people are willing to pay, you can see what's called demand destruction. I think it's going to be hard for companies to continue to pass on these price increases. And you can see it because both Walmart and Target came in, missed expectations, have a much more dire outlook. And, Walmart's a bellwether. So as Walmart goes, the stock market goes to some degree. And it's no surprise based on what we saw there. The stock market has fallen quite a bit since the beginning of the year. And I don't think we're done yet. I'm going to get to some of the technicals a little later, but I'm just kind of laying out the big picture as to how we see it. This week, the Fed Chairman Jay Powell came out and reiterated their commitment to fight inflation. And so that, we're going to continue to see that be a headline risk. And the reality is, I think the market understands fundamentally that short-term rates are going to go up for at least the next 2 months. So I think June and July, we're going to see a 0.5% increase in the federal funds rate, which, by the way, is already priced into the market. The market knows and has priced this in. And so I don't think that's really a big deal. I think by the time July rolls around, the Fed's going to have a lot of cover to kind of back away and say, okay, we've raised the short-term rates. We're going to kind of take a pause because some of the leading economic indicators are rolling over and it looks like the economy is slowing down. And I think it's at least plausible / maybe likely that the Fed will pivot. But that's a couple months away. And so in the meantime, what you've got is a game of chicken between what we'll call price discovery in the equity markets and the Fed's sort of commitment to fighting inflation. And again, I think a lot of this is political. Obviously, inflation has been a political weapon. There's an enormous amount of pressure on the Biden administration to look like they're doing something. And to be fair, it's not really mostly the Biden administration's fault that we're in the mess that we're in. They're certainly they're culpable to a degree because people that are affiliated with that line of thinking, here in Michigan, Governor Whitmer, out in California, Governor Newsom, and New Jersey and New York, and a lot of these, places that have more liberal leaders, they were definitely more aggressive in the lockdowns and the shutdowns and the mask mandates and all that other stuff, where they shut a big chunk of the economy down. And so we're seeing the impact of that, and so they are culpable to a certain degree, but they can't help that energy companies, like oil companies in particular, stopped production when oil prices dropped, which is a reasonable thing to do. And they've been slow to ramp up production again because they don't want to get caught with their pants down. During the height of COVID, the price of a barrel of oil dropped below $10 and actually went negative for a split second. So you can understand why big energy companies, oil companies that answer to shareholders, weren't really going to be quick to ramp up production in the event that prices came down again. So I can understand that. And then you've got, obviously, leases that weren't renewed and energy policies and the cutting of nuclear, all this stuff. I mean, it's all having an impact. So there's a lot of people that are going to be held accountable for this. But in the meantime, energy prices have gotten high, and that's going to create demand destruction. So I think the Fed is driving everything here. Okay. There's a lot of talk about Jerome Powell being, Paul Volcker instead of Ben Bernanke, Helicopter Ben, if you remember the helicopter money and all the printing coming out of 08 and 09. I think I would defer to Ray Dalio, honestly, on this front and say that, if you look at the history of countries that become indebted, particularly superpower countries like the United States is now, like Great Britain was, like the Dutch Empire was, and many others that just are too many to mention right now, they all kind of suffer the same fate. When they've taken on so much debt that it becomes unsustainable, the first move is always, and it kind of turns into the last move ultimately, is to devalue the currency, print a whole bunch of money, and try to get out of the problem by reducing the value of the debt and paying it back in discounted dollars. And so if we hold true to what historically has been undefeated, then I think you would have to say that the Fed's going to have to pivot at some point because, they have to walk a fine line. I don't hear a lot of talk about this, but I think it's really important. The United States has $30 trillion in debt. And so it's inconceivable to me that they'll allow a 10-year Treasury to get anywhere near 5%. And I think we've already maybe seen the high in the 10-year Treasury, because that's more set by the market. And the market, the bond market in particular, is looking kind of down the road, and they're saying, this is ugly. The shit's going to hit the fan here pretty soon. All of the leading economic indicators are pointing downward. And so if that is ultimately how it plays out, then I think the Fed doesn't need to raise rates anymore, because the market has already acted as if the Fed has raised rates more than they have, right? Mortgage rates are up at 5.5%. The 10-year Treasuries peaked at 3.2% so far. Short-term rates are on the rise. And so the cost of borrowing money has increased exponentially in the last year, and the Fed really hasn't had to raise rates as much as they've talked about raising rates. And so I think that gives them some room to back away, which I think is what they're going to do. Because in the end, I think that inflation will give way to unemployment. And there's no question that unemployment is going to rise. Companies are already starting to cut jobs. Netflix is cutting jobs. Apple, I think I read, is cutting jobs. And those are just the beginning ones. The auto market is starting to roll over. Their perfect storm of all of these high profits, it's gone, right? They took advantage of higher costs or higher pricing power, I should say, because of the semiconductor shortage, with high demand and low interest rates meant that it's really affordable for people to buy cars. And so even though the total volume of cars sold were down, the profitability was through the roof. And so these companies made more money by selling less cars. Well, that, my friends, is over. Okay, the auto industry is in for a rude awakening here. The cost of financing is going up. There's a lack of supply. Demand is going to start to roll over. And I think just the cost of producing cars is going to continue to go up, and it's going to meet a consumer that might be unwilling to pay these higher prices. And one of the indicators is that the average, there are loans now that are going out to 84 months, and the average car payment is now like $500, and people are financing more. So when you look at that data, it's not encouraging for the auto industry, at least in the short to intermediate term. And I think if you look at the housing industry, it's the same way. New housing starts are starting to roll over. They not roll over, they have fallen. Okay, so that's a big deal. And not only that, but I think something like 87% of all houses sold are sold with a mortgage. And so if you've got mortgage rates at 5.5%, they're basically as high as they've been since 1996. I think that's really going to slow the housing market down. And that leads us back to employment, because the housing market is one of the largest creators and producers of jobs of any industry. And so if the housing market starts to slow down, and I'm not even talking about prices right now, okay? We'll get to housing prices in a minute, but just in terms of new housing starts, when you think about the process, when somebody agrees to buy and build a house, okay? Once the house is built, they've got to landscape it, they're going to furnish it, they're going to put, anything from drawer handles to cupboards to curtains to pictures like the American flag behind my head, all that stuff, right? That all goes into along with the spending that takes place when somebody builds or buys a new house, right? So it trickles down. It trickles down into retail. It trickles down to Home Depot. It trickles down to a lot of different places. And if the housing market really slows down, that means that these companies are probably going to start to lay people off or fire people. And so what I'm driving at is that for now, okay, inflation is the enemy. It's the boogeyman that, the Biden administration is fighting. But as we get closer to November, it's going to be a bigger problem if a whole bunch of Americans no longer have jobs. They won't be as concerned about inflation because they'll be figuring out where their next paycheck is coming from. Okay. And so when you think about it from that standpoint, I think this whole transition gives the Federal Reserve cover to back away from the monetary tightening. And I would not be surprised as we get closer to November if not only do we go away from tightening to away from neutral to back to loosening again. And another sort of, I guess one of the things I'm looking for is I wouldn't be shocked if we start to see more fiscal stimulus. Because again, they have to dump money into the hands of consumers if the consumers don't have jobs. And they're going to try to buy votes in any way that they can. So I think that is, I'm not saying that's the highest probability outcome, but I'm saying it's not off the table and we have to watch for that. Okay, so I think in that sense, there's a lot going on, and we're not going to know how this plays out for a number of months. The volatility index is at 30. To put this into perspective, okay, the market, the Dow Jones today was down 1,100 points. The S&P was down 165 points. The NASDAQ was down 566 points. Okay, those are massive numbers. And yet, when you look at the volatility index, it's at 30. And to put this kind of into context, at the height of COVID, it got up to 80. So we are nowhere near the levels of panic and fear that we would need to see before this thing kind of bottoms out. And I'm going to get to the technicals here in a second, but that's not a good sign with the market falling like it did today and the VIX still at 30. The 10-year Treasury is back down to 2.88%. I'm going to make a loose call here, and what I'm going to say is that I think the 10-year Treasury may have peaked at 3.2%. I think the bond market understands the shitstorm that's on the horizon here, and it's looking at this going, we have a recession incoming. And there's more talk out of the Fed about trying to create this soft landing, and there's different pathways, which in my mind is not super likely. I think if you look at the global economy, we haven't even begun to see the impact really on corporate profits and earnings of what's going on in Russia. And the whole narrative that Russia kind of underestimated Ukraine, and they went in thinking they were going to blitzkrieg this situation and be in and out relatively shortly. That's BS. None of that was ever true, in my opinion. All you have to do is look at the history of how Russia has fought all of their wars. Russia has a high tolerance for pain, and they're in this for the longer term. I don't know what their objectives are. I guess we'll see. But my point is that this is going to drag on for a while. And I think the West, the United States and Europe, for reasons that I don't fully understand, seem to want to draw this out. At any point, Ukraine could have conceded certain things to Russia and probably ended the pain, but they haven't. And I don't see any way that Ukraine wins this war, sadly. And I'm Ukrainian, so it's not like I don't have a rooting interest here. But I think the next thing, and this is shocking to me, but you're going to start to hear more about this. Is the idea that the United States now is somehow going to have to start to help pay for the rebuilding of Ukraine. I mean, we just sent $40 billion. We just keep adding debt and debt and debt. And, I think that from a fiscal responsibility standpoint, this is not good. And the more debt that we take on, the more difficult it's going to be to balance, running a budget and servicing your debt payments while maintaining a stable currency, while maintaining a stable economy, and reasonable tax rates and all that stuff. So there's a lot to be concerned about right now. And as we get to the University of Michigan Consumer Index, I mean, it's now lower than it was during COVID, and it's about where it was in the global financial crisis, the GFC back in 2008. That does not portend well. And the last point on just the market update as far as these bullet points are concerned, the Empire State Manufacturing Index dropped by 35 points in 1 month. Okay, it's worse than it was in 08 and almost as bad as it was in COVID. So there's a lot of just really negative data here that I'm concerned about, and in no way does this signal to me that there's a bottom anywhere near. Now, what I've pulled up here is the S&P 500. From a technical standpoint, we bottomed out during COVID at around 2,100. We peaked out at I guess what is that? That's around 4,700, 4,800, somewhere around there. If you look at the support and resistance levels right here, we're at the 0.382. This is a Fibonacci retracement line. It's kind of providing support right now. If you can see, if you're listening to this, you can't see it obviously, but if you're looking at my chart on YouTube, you can see that around 3,800 has been a pretty important level of support on the S&P 500. I don't see how this holds up just based on everything we're seeing, unless the Fed. The only way, in my opinion, that this is likely to hold is if the Fed changes course sooner than we think. I don't think that's super likely. So I'm not saying it's due, like it's going to just dip tomorrow, but what I am saying is I don't think this is likely to hold. Okay. I think we're going to at least get down. This line right here is the 200-week moving average. Right now it's at 3,500. So I could see us easily going down to test 3,500, which is where the 200-week moving average is. But I think we're more likely to test the 618, which would get us down to around 3,200 on the S&P, and we'll see if that's a bottom. I don't know. It depends on what the Fed does. The NASDAQ is uglier. We already blew through the 0.382. We're back down. We hit the 0.5, which is around 11,800. We kind of jumped off it. Now we're heading. It's 11,928 on the NASDAQ 100 today. You're going to see this a few days later. So the point is that we're going back to test that support level. I think it's 10,600 is almost a foregone conclusion right now on the NASDAQ 100. The RSI's relative strength indexes are pointing down. VWAP, the volume weighted average price, heading back down. The money flows are negative. I mean, there's just nothing good about. And if you look at this chart, we've had from here a lower high. What looks now, I don't know where we're at, if this is a high or not, but we're certainly in a downtrend. So, the bottom line is the short-term outlook sucks. There's no other way to say it. From a management standpoint, what we've done at Sawchuk Wealth, we started paring back on equity exposure on January 24th. In the money that we have managed with outside managers, that money went about a third to cash in January. It's probably in the 40 to 50% range in cash right now, and we're probably heading to a higher percentage of cash, maybe 2/3 on that end. And then to counterbalance that, we put mathematical models in place that kind of limit our risk to the neighborhood of 10%. So those models are holding up well. I would say that this is a time to be cautious. I think cash is king. If you think about cash as an investment, you have to look at it and go, all right, what's the cost of holding cash? Well, let's say you get 0.5% in cash right now. The reality is inflation running at 8%. You're down 7.5% this year. If inflation slows down to, let's say, 6% next year, and cash moves up to, say, 2%, now your difference is only about 4%. So, against purchasing power, over the course of, maybe a year and a half, you're down 10%. But the benefit to holding cash is that ultimately when the markets bottom, you're buying in at incredibly discounted prices with great valuations. And you could easily make 30, 40, 50, even 75% in the bounce off the bottom by transitioning in at the lower end. Okay. And so the reality is cash is a great investment to hold at times, right? So I would say that there's nothing wrong with holding cash. We're certainly looking to buy when the valuations look appropriate to us and when the technicals tell us that it looks like we've bottomed out. And again, I don't think we're anywhere near that. I'm gonna wrap up this shorter podcast by just saying patience is a virtue. And there's no reason to buy the dip. If anything, any bounce that we get in the short to intermediate term is really going to be an opportunity to kind of sell out and reduce your equity exposure. Everything hinges on the Fed. Okay. When the Fed pivots that's when you're likely to see a bottom. And we don't know when that's going to be. And there's going to be, in the short term, there's political pressure on the Fed to kind of hold course. But within, I think, 2 to 3 months, there's going to be a lot of pressure on the Fed to reverse course. And when that happens, then we'll maybe get a green light and start getting back in. But between now and then, I would say it's risk off. It's not the time to be a hero. Cash is king. If you haven't, if you're not fortunate enough to be a Sawchuk Wealth client, and you didn't reduce equity exposure, I would look for a short-term bounce. We're going to get one eventually. I mean, it doesn't just go down in a straight line. So when you look at the technicals, we're already in the oversold range, but we're likely to maybe dip down a little further. Then we'll get a bounce. And that bounce is likely going to be a good opportunity for you to at least reduce some equity exposure there and hang tight until we get the Fed pivot whenever that happens. So I hope this was helpful. Follow us on YouTube. Just search out Sawchuk Wealth. Hit my website, Sawchuk Wealth, if you want more information. If you're a client, I'm sure that you're pretty pleased that we're on top of this like we have been, because you're certainly holding up better than the markets as a whole and probably most other people that are investing right now. This is not a buy and hold environment. And I think that's the key. People that tell you to buy and hold tell you that because they don't know how to time the market. But the markets absolutely can be timed. I'm not saying you're going to get the peaks. You're not going to sell the peaks. You're not going to buy the valleys. But you can certainly risk manage, take risk off as the market is kind of near the higher point. You can start to risk back on when the technicals tell you that it looks like it's safer to enter. And we have the tools to do that. And we've been doing it successfully for our clients for a long time. So with that said, thanks for tuning in. Again, hit us up and subscribe on Sawchuk Wealth on YouTube. You can go to Apple or wherever else and download the podcasts. You can hit our website for all kinds of media content. If you want to sit down and talk to us, by all means, you can click to the Calendly link on our website and schedule a 15-minute phone call to see if we're a good fit. If you're an existing client, share this information with people that you care about, because money is what determines quality of life. And we're here to help people improve their quality of life by hanging on to their money and not getting whacked when we go through these really, really difficult times. So with that, thanks very much, and we will see you next time on Inside the Lion's Den.